You know, usually when we talk about a massive technological leap, there's this underlying assumption that the companies building the future are the ones who are going to get rich off it.
Right, yeah, like it's a law of gravity in tech or something.
Exactly. But what if, for you, as a curious observer trying to bypass all the industry noise right now,
Yeah.
what if the most mind-bending premise of the AI revolution isn't about artificial general intelligence or rogue algorithms?
Oh, man, yeah. The real twist is something else entirely.
Right. What if the real twist is that this AI build-out turns out to be a spectacular, world-changing technological success, but just an absolute unmitigated financial disaster for the companies footing the bill?
It's wild to think about. I mean, usually if a new technology works as promised, the founders and the backers are buying yachts.
Yeah. Yeah.
But here we are looking at a scenario where the technology might perform flawlessly, yet the companies building the infrastructure could still face bankruptcy. Because, well, they've taken on these massive hidden mortgages they simply can't afford to pay off.
It's crazy.
Ah,
And welcome to today's deep dive. We are looking at a fascinating and frankly kind of terrifying thematic research report on AI infrastructure.
sure.
This is dated August 9, 2026.
Very recent, yeah.
And our mission today is to figure out if the financial architecture funding the U.S. AI build-out can actually survive the success of open-weight models.
Yeah, it's a big question.
A huge question. And to set the scale here, because the numbers in this report are just, they're staggering. In 2026 alone, 5 U.S. platforms are deploying roughly $788 billion in capital expenditure.
Yeah.
And on top of that, 4 major cloud providers are reporting $2.33 trillion in contracted backlog.
Which is a number so large it almost loses its meaning.
Totally.
But when the market sees $2.33 trillion in backlog, they interpret that as guaranteed future revenue. The narrative just becomes bulletproof.
I look at this like personal finance, right?
Yeah.
The market's throwing a massive party because these companies just secured a $2.33 trillion future salary.
Right.
But I feel like everyone is completely ignoring the crushing debt they are signing up for just to commute to that job. I mean, if we're talking about guaranteed revenue, we have to talk about guaranteed obligations.
We do. And we have to separate those obligations into 3 very distinct buckets because, lumping them together hides the actual danger.
Okay, lay them out for me.
So the first bucket is that capital expenditure, the $788 billion you just mentioned.
Right, the CapEx.
Exactly. That is liquid cash going out the door today to buy chips and servers. The second bucket is the contracted backlog, the $2.33 trillion, which is future revenue they will recognize as they deliver cloud services.
Makes sense.
But the third bucket is the landmine, and that is uncommenced leases.
Okay, I saw that term in the report, and it sounds like, I don't know, an accounting loophole.
Mm-hmm.
What exactly makes a lease uncommenced?
It basically means the company has signed a binding long-term contract to lease a massive data center facility, but because the building is still under construction or the power isn't turned on yet, the facility isn't actually ready for use.
Oh, wow.
Yeah. And because of how accounting rules work, these obligations do not appear as recognized lease liabilities on the main balance sheet. They're just buried in the footnotes.
Wait, so it's a shadow mortgage? Like, if I sign a lease for a luxury apartment that's still being built, and I haven't moved my furniture in yet, I still owe the money.
Exactly.
The landlord doesn't care if I'm sleeping there or not once the building is done. That contract is locked.
And the scale of these locked contracts is terrifying. The report reveals that these firms have committed to approximately $1.09 trillion in future lease payments that haven't commenced yet.
$1 trillion.
Over $1 trillion. To put that in perspective, that hidden 1.09 trillioners is nearly 4 times the $285 billion in leases that are actually visible and recognized on their balance sheets today.
4 times the visible amount. That is insane. And Oracle's position in this report, it blew my mind.
Oh, Oracle is a prime example here.
Right. The report states Oracle has $260 billion in uncommenced lease commitments, but they only officially recognize $37.89 billion on their balance sheet. That is a 7-to-1 ratio of hidden obligations to recognized debt. And they are not exactly sitting on an invincible credit rating, right?
Far from it. Oracle is rated BBB. In the credit world, that is exactly 1 notch above high yield, which is, the polite industry term for junk status.
Status, wow.
The report notes they have borrowings near 4.4 times their trailing EBITDA.
Okay, let me pause you there to make sure I understand the mechanics, because I want everyone listening to follow this. EBITDA is just earnings before interest, taxes, depreciation, and amortization.
Right.
Basically, it's just a measure of their core operating cash flow, right?
That's a great way to summarize it. It's the raw cash the business generates from its operations before the accountants get involved.
Got it.
So currently, their visible debt is 4.4 times that annual cash flow. But if you take those recognized leases and add them into the mix, that leverage ratio jumps to 5.7 times.
Ouch.
And remember, that doesn't even include the $260 billion shadow mortgage coming down the pipeline.
So they're heavily leveraged, sitting precariously above junk status, and they have this mountain of uncommenced leases waiting to drop.
Yes.
But it gets worse, right? Because there's this fundamental mismatch in the timeline of what they are buying versus what they are leasing.
Oh, the duration mismatch is the silent killer here. AI hardware-like, the physical accelerators actually processing the data, has a useful life of maybe 4 to 6 years before it becomes completely obsolete.
Right, because the tech moves so fast.
Exactly. But these uncommenced data center leases, the contracts generally run 15 to 19 years.
That's like taking out a 20-year auto loan on a laptop.
Pretty much.
By the time you're halfway through paying it off, the equipment inside is a museum piece.
The hyperscalers know this, of course, and they are actively trying to negotiate shorter lease terms. But real estate developers aren't stupid. They won't build a massive data center on a 5-year lease.
Right, it doesn't pencil out for them.
No, it doesn't. So to get any concessions on duration, the tech companies are having to provide significant off-balance sheet guarantees. They are acting as the ultimate backstop.
Wow.
And the only way this financial house of cards stands is if the core assumption of the AI boom holds true, which is that these AI companies will retain immense pricing power.
Right, they need to be able to charge premium prices for access to their frontier AI models indefinitely, just to pay off those 19-year leases.
Exactly.
But looking at the data from August 2026, the market is actively refusing to pay those premiums. Like, the rug is being pulled out from under them right now.
It really is. The report pulls data directly from a major AI gateway's daily open data export, tracking who is spending what.
Okay.
And in mid-June of 2026, Chinese open-weight laboratories accounted for just 3.95% of total production spend.
A blip on the radar, basically.
Totally. But by August 9th, so less than 8 weeks later, that share skyrocketed to 15.71%.
In 8 weeks.
Yeah. And if we look at the actual volume of work being done, their share of tokens processed crossed the majority threshold, hitting 51.9%.
Wow.
Meanwhile, the 4 largest U.S. laboratories saw their spend share fall from 95% down to 83% in that exact same window.
Okay, I'm looking at this Chinese market share jump, but I have a hard time believing major enterprises are trusting free, open-weight models with their most complex premium tasks.
That's what everyone thought.
Right. Aren't they just using these open weights for, like, basic coding, autocomplete, and low-tier customer service chatbots?
Yeah.
Because the narrative has always been that the massive, expensive U.S. models would retain all the complex reasoning work.
Yeah, that was the segmented market defense. The industry just assumed a 2-tier system would protect frontier economics.
Sure.
But this recent surge isn't just a volume play of cheap, low-value tokens. The disruption is being driven by one specific model, and that's Moonshot AI's Kimi K3, which was released in mid-July 2026.
Okay.
To see why this breaks the U.S. business model, we have to look at the mechanics of something called revenue intensity.
Hold on. Revenue intensity sounds like one of those corporate buzzwords they use to justify a bad quarter on an earnings call.
Yeah.
Are we just talking about how much money a model makes compared to how much computing power it hogs?
It's actually a very elegant metric when you break it down. You take a model's share of total network spend and divide it by its share of total network token volume.
Right.
If the ratio is exactly 1.0, the model is perfectly average. It captures $1 of spend for every proportional token it processes. But if it drops below 1.0, it means the market is routing cheap, high-volume commodity work to it.
Okay, so a model like DeepSeek, which the report mentions, processes, what, a quarter of all gateway tokens, but has a revenue intensity near 0.08. It's basically the dollar menu of AI.
Yeah, that's a great way to put it.
Like, it does a ton of work, but nobody is paying a premium for it.
Precisely. But if a model's revenue intensity climbs above 1.0, it means buyers are deliberately routing premium, high-stakes work to it.
I see.
Work where the quality of the output carries real business value, and they are absolutely willing to pay for it. And by August 9th, Kimi K3 reached a laboratory revenue intensity of 1.42.
Wow, meaning it's capturing significantly more dollars than its sheer volume would suggest.
And at the specific model level, Kimi K3 hit 1.57.
No way.
Yes, that places it above Google's models and above Claude Sonnet 5 in terms of premium routing. This is the smoking gun. It is empirical evidence that the frontier premium is no longer defensible simply by having a massive capability moat.
So the moat is gone. And this creates this wild economic paradox, doesn't it?
It really does.
Because the technology itself is a massive triumph. I mean, these models are highly capable, they are doing premium enterprise work, they are getting incredibly efficient. But the capital backing the U.S. build-out is bleeding out.
Yeah.
Because they can no longer charge the luxury prices they modeled into their spreadsheets to cover that $1.09 trillion in hidden leases.
It completely upends our assumptions about value capture and technology. You hear AI's total addressable market constantly compared to the global wage bill, which is roughly, what, $50 trillion in labor compensation?
That is the ultimate venture capital pitch. Like, if AI can automate even a fraction of human labor, how can you disrupt a $50 trillion market and not make a killing? It seems impossible to lose money on that scale.
You'd think so. But because value created for society is rarely the same as value captured by the creator.
Right.
When AI succeeds and highly capable open weights like Kimi K3 flood the market, the price of digital intelligence fundamentally drops toward the marginal cost of computing it.
Wow.
The massive economic surplus generated by AI doesn't accrue to the balance sheets of the AI companies. It gets handed over to the buyers and the consumers in the form of drastically cheaper services.
So the AI companies are taking out the mortgages, pouring the concrete, and burning the electricity just to subsidize cheaper intelligence for everyone else.
Exactly. And, this isn't a new phenomenon. The report uses an incredible historical analog to ground this, which is the Long Depression of 1873 to 1896.
I have to say, the 1870s is not the era you usually hear tech CEOs quoting when they talk about the future.
No, they prefer the gold rush.
Yeah, exactly.
But the 1870s is the mechanically accurate parallel here. During that era, the build-out of railroads, telegraph networks, and steel production created massive real-world productivity.
The technology worked.
The technology was a resounding success. But because of chronic overbuilding and brutal competition, shipping rates collapsed. We saw persistent deflation.
Right, so the farmers and the merchants won because shipping grain became incredibly cheap.
Exactly. But the railroad equity and bondholders got repeatedly wiped out. Nominal profits for the infrastructure builders just vanished.
That is fascinating.
The technology worked, society leaped forward, but the capital that financed the leap was destroyed. And we are seeing the exact same deflationary pressure hitting the software sector right now in 2026.
If you are listening to this and you work in traditional B2B SaaS, this is the part that should make the hairs on your arm stand up.
Oh, definitely.
It's not just that AI is cool, it's that AI is actively making your core product cheaper to replicate. The report points out that private credit vehicles, specifically business development companies, have lent about $115 billion to software firms.
Let's break down why that matters real quick. Business development companies, or BDCs, are essentially non-bank lenders.
Okay.
They pool capital to lend to mid-sized companies that might not get traditional bank loans. For many of these tech-focused BDCs, over 80% of their lending portfolio is tied up in traditional software companies.
And because AI is allowing lean startups to just write code and spin up software competitors at a fraction of the historical cost, the value of those legacy software companies is plummeting.
Right.
Between October 2025 and February 2026, software equities dropped almost 30%. Private equity is already pricing in the fact that software just isn't worth what it used to be.
The AI disruption is a double-edged sword. It is actively impairing the software borrowers on one side of the private credit book, while simultaneously threatening the data center collateral on the other side.
So if software buyers are getting crushed, and the AI models themselves can't maintain premium pricing, who goes bankrupt first when these massive data center debts come due?
It comes down to counterparty concentration. In a systemic stress event, survival depends entirely on who is doing business with whom.
Okay, that makes sense.
Let's look back at that $2.33 trillion in aggregate contracted backlog. It is not evenly distributed.
Right, so Microsoft has $678 billion in backlog, and the report estimates that roughly 32% of that is linked directly to OpenAI. That's over $200 billion tied to a single customer.
It's a massive exposure, yes,
Yeah.
but Microsoft has a fortress balance sheet. Nearly 90% of their full-year cloud revenue comes from outside frontier model companies. They can absorb a shock.
Okay, that's fine.
But then look at Oracle. Oracle, our BBB-rated friend with the $260 billion in shadow mortgages, has roughly half of its $638 billion backlog linked to OpenAI.
Wait, half?
Half.
So roughly $319 billion of Oracle's promised future is riding on OpenAI's ability to pay their bills.
Yep.
And how is OpenAI holding up in this price war against the open-weight models?
They are taking heavy damage. To defend their token volume against highly capable models like Kimi K3, OpenAI had to aggressively cut prices. We can see the result in the gateway data. Their revenue intensity plummeted from 1.36 down to 0.66.
Ouch. They went from capturing premium dollars to doing commodity work just to keep the lights on.
Exactly. They are losing their luxury status. If OpenAI struggles to generate the cash needed to honor those cloud contracts, Oracle is standing directly in the blast zone.
And Oracle does not have the balance sheet to absorb a $300 billion hole.
No, they do not.
Meanwhile, the report notes that Anthropic actually increased its revenue intensity, rising from 2.3 to 2.57. And their principal contracting is with Google and Amazon, who have bulletproof balance sheets.
Right.
The financial system has actively concentrated the weakest creditor Oracle against the most price-pressured borrower, OpenAI.
That is the hallmark of a fragile system.
But wait, let's talk about Anthropic for a second, because the report notes they recently projected their first operating profit of about $559 million in Q2 of 2026.
Yeah.
On the surface, that looks like a massive win. You'd think, hey, the system works, Anthropic figured it out. But when you dig into the mechanics of how they achieved that profit, it involves a really wild deal with SpaceX.
It's a fascinating network node that exposes how tenuous these margins really are. Anthropic's projected profit isn't driven by a sudden surge in premium pricing. It rests heavily on cost cutting.
Right.
Specifically, their compute cost per revenue dollar fell from 71 cents in Q1 to a projected 56 cents in Q2.
Which is a 15-cent improvement on every dollar. If I'm an investor, I'm thrilled.
Yeah.
But where did that 15 cents come from?
Well, in May 2026, Anthropic signed a contract to pay SpaceX $1.25 billion per month through May 2029.
Okay.
In exchange, they got dedicated access to the Colossus One facility in Memphis. This is a monster facility. It has over 300 megawatts of power and more than 220,000 accelerators. But critically, SpaceX offered a massive reduced ramp-up discount that applied through May and June of 2026.
So that 15-cent drop in compute cost perfectly aligns with a temporary bargain basement discount from SpaceX.
Exactly.
But let's connect the dots here. Why on earth is SpaceX, an aerospace company, handing out steep discounts on state-of-the-art AI chips?
To understand that, you have to understand the decay of compute value. Compute power isn't like real estate, where the land holds value. An AI accelerator is like a ripening avocado.
A ripening avocado?
Yeah. It loses value every single day. It sits there as newer, faster chips get closer to market. SpaceX had this massive facility available because their own AI segment, xAI, couldn't fully utilize it. Colossus One was reportedly running at just 11% utilization before they signed this deal.
Oh my God. So they had 220,000 chips just sitting idle, burning millions in depreciation and power, doing absolutely nothing.
They had a stranded asset. They had to sublease it at whatever price they could get just to stop the financial bleeding.
Right.
Anthropic grabbed the absolute cheapest available capacity to artificially boost their Q2 margins. And SpaceX turned a direct competitor's stranded asset into a cost base. And the kicker?
What?
Either party can terminate this massive deal on just 90 days' notice.
That is incredible. It's not a structural victory for the AI business model. It's a discounted sublease born out of desperation.
Precisely.
Okay, but we've been talking about the software buyers, the AI labs, and the data centers taking on all this risk. There's one company that everyone assumes is completely immune to this fallout because they already got paid for the hardware, right? NVIDIA.
Right. The assumption is that NVIDIA is perfectly insulated from the chaos. On their executed balance sheet, they look incredibly healthy. Operating cash generation is sitting at $50.3 billion. They aren't struggling to pay their bills.
Yeah.
And they appear diversified. Roughly half of their data center revenue comes from outside the top 4 hyperscalers.
Everyone assumes NVIDIA is the toll booth on this AI highway. They get paid the toll, regardless of whether the cars are driving to a luxury mansion or driving off a cliff.
Yeah.
But this report suggests they might actually be co-signing the car loans, too.
That is the perfect analogy, and it brings us to a bombshell unexecuted deal currently under negotiation that fundamentally alters NVIDIA's risk profile.
This is the crazy part.
The Wall Street Journal and Reuters reported that NVIDIA is negotiating a massive backstop arrangement. They are looking to guarantee approximately $250 billion in lease and construction financing for a 10-gigawatt OpenAI data center campus in Piketon, Ohio.
10 gigawatts.
Yeah.
Just to put that in perspective for you listening, that is the size of a small country's entire power grid dedicated to a single campus.
Developed by SB Energy, which is a SoftBank subsidiary,
Mm-hmm.
but the exposure doesn't stop at the concrete and the power.
Oh, right.
NVIDIA is also reportedly negotiating to finance up to $350 billion of OpenAI's future chip purchases. Combined, that is nearly $600 billion of contingent exposure tied to one single company.
I have to stop you there. Why would NVIDIA, a company practically printing money, basically co-signed a $600 billion mortgage for a single customer, especially a customer like OpenAI, which is projected to lose $14 billion in 2026?
Because of the void in credit markets, we discussed this earlier, OpenAI lacks an investment-grade credit rating.
Right.
No traditional syndicate of banks is going to lend $600 billion at manageable interest rates to a company burning $14 billion a year in a brutal price war.
So the banks need an adult in the room to guarantee the debt.
Exactly. To get the Ohio project funded, the lenders need a pristine balance sheet to price the debt against. NVIDIA's pristine balance sheet essentially substitutes for OpenAI's lack of one.
Wow.
Under this proposed guarantee, NVIDIA wouldn't hold equity in the data center. They wouldn't participate in the upside. They would simply sit as a contingent creditor taking on massive downside risk just to ensure the chips keep getting bought.
They are artificially propping up their biggest buyers so the revenue keeps flowing. But let's play this out. If OpenAI's revenue intensity stays crushed at 0.66, and they eventually default on these payments, what actually happens to the broader market?
Well, if this guarantee is signed, the containment logic of the entire financial system changes. Right now, if OpenAI struggles, the stress hits weaker, contained players like Oracle.
Right.
But if NVIDIA signs a $600 billion guarantee, an OpenAI default transmits that massive liability directly onto the balance sheet of the largest constituent of the S&P 500 index.
Wait, let me make sure I understand the mechanics of the market contagion here. Because if I hold an S&P 500 index fund, that fund just mechanically holds the stock based on its market cap.
Yeah.
If NVIDIA's stock price drops, my fund doesn't panic sell. The weight just adjusts downward, right?
Yes, a cap-weighted equity fund is relatively passive in a downturn, but credit markets operate under entirely different, ruthless mechanics.
How so?
If a company takes on too much liability and gets officially downgraded below investment grade, mandate-driven credit funds are triggered.
Meaning certain institutional investors, like pension funds, are legally banned from holding junk debt.
Exactly. They are mechanically forced to sell the bonds, regardless of the price. That forced selling destroys the company's ability to raise new debt, which triggers a liquidity crisis.
Oh, wow.
That's why an Oracle downgrade or a massive contingent liability hitting NVIDIA's credit rating is the actual tripwire for broad market contagion. It forces institutional panic.
Okay, let's pull all of this together for you listening.
Thanks.
We are currently watching the greatest, most concentrated private infrastructure build-out in modern economic history.
Without a doubt.
$788 billion in cash out the door this year. $2.33 trillion in promised backlog. But the foundation of this entire structure rests on one fragile premise, which is that U.S. AI companies can maintain premium pricing to pay off over $1 trillion in hidden, uncommenced 15-year leases.
And that premise is actively collapsing. Chinese open-weight models, specifically Kimi K3, are successfully routing premium work away from the expensive frontier models, driving the price of intelligence down to the marginal cost of the electricity required to run it.
Yeah.
The technology is succeeding brilliantly, but the economic surplus is being captured by the consumers, not the companies holding the debt.
It's the 1870s railroad boom playing out in real time. We have the weakest credits, like Oracle, carrying the most exposed counterparties, like OpenAI.
Yeah.
And we have NVIDIA considering a $600 billion gamble to act as a co-signer just to keep the build-out alive.
Yeah.
It is a financial house of cards built on 19-year leases for hardware that rots in 5.
It really is. And I want to leave you with one final, deeply unsettling thought regarding the macroeconomic fallout here.
Okay.
If we look back at historical templates, like the Industrial Revolution, the rollout of electricity, or the dawn of personal computing, those transitions generated immense wealth, but they played out over decades.
Decades to adapt, right? We had time to figure it out.
Exactly. That timeline allowed the broader economy to naturally adjust, to reskill labor, and to slowly absorb the destruction of legacy capital.
Sure.
But what happens if the AI transition doesn't afford us decades? What if, because of the sheer scale of the capital deployed and the rapid capability gains of open-weight models, this entire transition compresses into just 3 to 5 years?
A 3-year industrial revolution.
If you rapidly displace junior knowledge workers, instantly write off hundreds of billions in traditional software valuations, and strand massive data center assets because the models commoditized faster than the 15-year leases could be paid,
Yeah.
the sheer speed of that adjustment means the transition period itself is the recession. The global economy simply cannot reallocate labor and capital fast enough to absorb a structural shock compressed into 36 months.
That is heavy. A technological success so fast and so absolute that it shatters the financial architecture meant to support it.
Well, thank you for joining us on this deep dive. As you watch the tech headlines roll in this week, look past the hype, look past the new capability benchmarks, and keep asking yourself one simple question. Who is really capturing the value? Because it might just be that we're building a spectacular, world-changing future, entirely financed by a spectacular financial disaster.